One of the realities of trading is that depending on the market, you can see consolidation as much as 80% of the time. So, with that in mind, you need to be able to handle these types of situations. Now, I've already done an exit video with a trend, a simple, follow higher lows or lower highs or whichever direction you're going. But in this video, I'm going to look at something that happens, quite frequently, and that is range bound trading. And in front of you, I have the euro pound. And the reason I've picked this particular pair is that currently we're going through the Brexit negotiations, and nobody really knows how that's going to end up. And it has a lot of traders on the sideline. And as a retail trader, you can take advantage of this because you don't have huge positions to move. You might be talking too many lots or something, so that's not going to move the market against you. And you can kind of tread carefully in the footsteps of elephants, as it were. Now, there's a lot of different ways you can define a range-bound market, or at least look for it. One thing you could do is maybe insert a moving average, and by doing so, you kind of get an idea that we're flattening out. This is a 50-day moving average on euro pound, and we were going higher and then just kind of lost momentum. You could make an argument for that's one way to go. As you know from the earlier videos, 0.90, nice large round number. Of course, there's going to be reaction there, and we continue to see that. But we also see somewhere around 87.50, there seems to be support as well. And we've seen that before. And why is that? Well, there's a gap here. So it makes sense between the gap, which, is probably a little closer to 87, but 87.50 or so is the area where the buyers come in and get aggressive. And 0.90, we have a lot of supply and demand, as it were. So how do we take advantage of this? One of the biggest things about range-bound trading is its simplicity, I think, scares people. Because I have a stochastic oscillator here, and we have crossed in the overbought position at roughly here. And you can see that selling there would have gotten you, and remember the moving average was flattening out, would have gotten you profit. It would have taken you a while, would have taken you a couple weeks, but you would have gotten down to there. You formed a hammer right here where you've seen a gap in previous support, and you're crossing over in the stochastics. Makes sense that the buyers would come. Well, where are you going to look to go? You're going to look to go the latest high here at 0.90. We formed a perfect shooting star right at a stochastic cross. We broke down. We cross over about here, and you can see we ended up forming a big hammer, and then we rallied again. So there's been 4 trades here over the last couple of months that would have netted about 250-ish pips, depending on when you got in. And you have to keep in mind that in this pair, the pip value is higher. So it's really closer to, say, 400 in like the euro dollar or something. So there's a lot of money to be made here by market indecision. Now, that brings up the next question. Well, what happens when I short it and it goes higher? Well, you take your loss and you move on. But think of it this way. If you have a signal on an oscillator in between two obvious ranges like this, the odds are going to work out in your favor. And had you taken all 4 of these trades, and let's say we go up here and we get a reversal signal, and instead of falling, it breaks through. So say you shorted it here. You've lost one of your positions, in even worst case scenario, say you lost 100 pips. Well, throughout this time, you've made roughly 1,000 pips. So that's, and granted, that's easy math. I realize your entry isn't going to be perfect every time, but that's like a 9-to-1 ratio. I mean, if I told you as a market, a participant or a money manager, hey, look, I can take your money and I can guarantee that for every $100 I lose for you, I'm going to make you 900. You would jump all over that all day long. And that's how you have to look at these types of trades. Another thing that I would point out, and I used to teach something called box trading. And box trading is essentially you get a rectangle like this, and then you eventually get an area that becomes middle range. Now, that is an area that's considered fair value in the market. So really at this point, you could say that fair value is somewhere around 88.75. So, for example, if we fail here and roll over and break down, that's a confirmation that the overall trend is changing to the downside. Just as if we rally to the top of the box and we come back down and test the middle point, but only the middle point and not reach the bottom again, a lot of times that's a sign that we're going to break out. Now, again, none of this is 100%, but you have to get it out of your head that all trades work, because they don't. It could be an error headline. It could be something that's said on Twitter that sets a market on fire for 5 minutes that takes you out. You have to get beyond that. And that is essentially what this type of trading ends up being. You understand that a lot of times you're going to get, and especially in range-bound pairs like this, and this pair does tend to be range-bound. There are some out there that are more susceptible to it than others. For example, Swiss yen. And why is that? Swiss yen, because they're both safety currencies. So they tend to go sideways a lot. But you can see this worked out quite nicely for a couple of years in euro pound. So let's go ahead and take a look at Swiss yen and see if if you notice a pattern here. And like I said, the whole reason being is that they are both safety currencies. So on the weekly chart, you can see it doesn't look like much, but that's about 10 months. It doesn't look like much, but that's a couple weeks. That's several months. That's half a year that you could have been trading in basically a range. These aren't perfect, of course, and we would have to drill in and kind of look for our levels. But look for these round numbers and the way that the markets behave, because a lot of times they can give you the opportunity to pick up, some easy trading back and forth. You could have had a system for the last 4 months now that would have worked quite nicely. And you have historic precedents for these areas to matter. So until you break out, you just rinse and repeat. It's the easiest way to trade. It really is. It takes a phenomenal amount of patience. And, you have to be able to just sit on a trade. And that's one of the biggest problems Forex traders faces, as a retail trader. You can even do a line chart. You don't even have to get, based upon candles or bars. Some people will just go back and forth. They don't bother with anything. They just notice a couple prices and they play it until it works out. You go understanding that you will eventually fail. But the idea is if you can get 2 or 3 wins and get a loss, that's okay. You came out ahead. So I want you to look at consolidative trading like that, because it's where most of the work is to be done. You just put a stop just outside of reach of the area, 50 pips or something on a daily chart at least, maybe even 100, and you just let it go. On a 4-hour chart, you can do that as well. You maybe can tighten up your stops a little bit, and it would have worked the same here on the 4-hour chart. Use an oscillator just to kind of verify, this move here was a bit low, it was oversold, and you went long and you're making money so far. But how involved do you want to get with the technical analysis as far as oscillators and indicators is up to you. But I want you to start looking at these as repeatable patterns. Remember the support and the resistance videos from the beginning of the course. That's where this becomes very important. Just as in this situation, if we break out, say to 0.9075, we've cleared this area, well, then obviously we're going to go looking to the highs again. It becomes a trending market, and you exit it that way. Remember, the market tells you what it wants to do. You just have to listen.